Welcome back to this session 11. In this session, we shall continue to discuss the other transaction the business entity incurs in the month of June. And we shall close the account up to June. That means from April to June is the first financial period of the entity. And this will be closing the accounts in the month of June and see that how the first account will look like. Now, in this case, as we have discussed that in these sessions of lecture number 11, so we shall discuss about the further transactions. But before we go to the further transactions, now is the time to understand the implication of numbers which appear in the P&L and balance sheet. You are quite clear about how these items and numbers are appearing balance sheet and P&L, because you yourself have seen that how these entries have been prepared by adopting the principle of inflow and outflow of fund. Now we shall discuss about the meaning of it. Now let me take one after another questions and see that how we can get the meaning of P&L and balance sheet. Here my first question is that what do you understand by fixed assets amount of 50 lakhs? Now here, first of all, this entry belongs to first entry or second entry. As you can see, and if you can recollect correctly, now the first entry would be the debit balance sheet asset bank or credit liability creditor. So this is immediate inflow would be the debit balance sheet asset bank, immediate outflow credit balance sheet asset bank, or deferred inflow would be the debit balance sheet asset receivable, or deferred outflow with the credit balance sheet liability creditor. So apart from these, all other entries in the balance sheet and P&L would be the second entry. So here, the plant and machinery is the second entry. Does the fixed assets represent the first entry or second entry of accounting entry? Definitely second entry, because the first entry would be bank, receivable, here it is not there, we'll see later on, and creditor. Now, if it's a second entry, and second entry, it's debit. So what does it mean? It's an inflow or outflow. If second entry is debit, definitely first entry would be credit. First entry credit comes where? There's an outflow of fund. So that means, now, is the balance is in debit balance or credit balance? Debit balance. What would be the first entry? Debit or credit? Credit. Now, first entry credit means outflow as what goes out credit. It means that the entity has incurred an outflow of rupees 50 lakhs on account of purchase of plant and machinery. Like this, we can get the implication of any heads of the balance sheet and P&L. Now, the next question is that since this is asset, this would be used for generating income. Is it good or is it bad? Now, the answer to this question is that it would be good as long as the assets are utilized properly. That means assets are used to generate sales. Now, let us take another one. What do you understand by the capital amount of 100 lakhs? First of all, it's a first entry or second entry. No doubt about it, it's a second entry. Now, is it a debit or credit? It's a credit. If second entry is credit, first entry would be debit. If first entry is debit, it's an inflow or outflow? Definitely inflow. Because inflow means what comes in is inflow, and in that case debit. So it means that the entity has incurred an inflow of rupees 100 lakhs on account of capital. It's that simple only. Apply the logic and you get the answer and get the meaning. Since this is liability, this is a temporary inflow. Now, is it good or is it bad? It would be good as long as the fund is used for generating revenues. So that means when this liability is taken by the entity in the form of an equity, if it is used properly and generating revenues, then it is good. Otherwise, it may not be good. Next, what do you understand by consumption of raw material of 30 lakhs? Is it a first entry or second entry? Definitely second entry. Now, it is debit or credit? It's a debit balance. Second entry, debit. So then naturally the first entry would be the credit. Credit means outflow. So it is an outflow. And since it is coming in P&L expenses, it's a permanent outflow. So it means that the entity has used raw material of 30 lakhs from its storage. There is no actual fund inflow or outflow because of this. Since this is an expenses, this implies that the goods are moved out of the store. Is it good or is it bad? It would be good if the business converts it into sales and then realize the sales. Here, sales has not happened. If sales has not happened, then it is not the desired thing. Now, if the sales would have happened, then it would have been better. It may be possible that the company requires a certain period of time of more than a month. In that case, it is fine. But the aim should be the goods or expenses should be converted into sales and realize it. Same concept if you look at it. This is second entry, debit, first entry would be credit. Now it's an outflow, salary and expenses, that means outflow has happened. Is it good or bad? Same logic. If the expenses is more than the benchmark, it is bad. So that means every industry or entity will have a benchmark. Now, if the expenses is more than the benchmark, then it is not good. Now, what do you understand by creditor of expenses of 6 lakhs? Now, creditor, is it a first entry or second entry? As you know, it's a first entry. Now, it is credit balance, outflow. Now, what means that the entity has incurred expenses on deferred basis and the amount is not paid. It means that it has to make the payment. Is it good or is it bad? Not paying beyond a point of time is bad, because business entity, if it has to continue to run operation, it has to pay creditor on time. If it pays creditor on time, the creditor will give material, and from that also the entity will be purchasing material and the transaction will go on. So if the creditor is extended beyond a point of time, it is not good. What do you understand by inventory of rupees 12 lakhs? Now, let us look at it. Why WIP is appearing in the balance sheet, to get the meaning of WIP. If you look at it, this is the WIP. WIP is coming because of what? Matching principle. So matching principle is that in that case, since the company's incurred expenses but could not convert it into cash, so this amount of expenses would be adjusted. Now let us look at it. Now WIP 25 lakhs. So this is the 25 lakhs WIP, increase in WIP. Now if you look at it, what does this WIP means? It is on account of expenses. That means the business entity has incurred certain expenses but could not convert into finished goods. Now, due to the matching principle in the balance sheet, to reduce the expenses to that extent, for this amount, already the outflow has happened. It is expected that the future inflow take place from WIP. Is it good or is it bad? Had it been converted into sales, it would have been definitely good. If it is absolutely required to keep an WIP for smoothness of production process, then it is good or it is acceptable. In case an entity can produce sales with least amount of WIP, it is better. So fund is blocked. So what is the conclusion? If company could have avoided WIP, that would have been better. If the company is not able to avoid it, it has to minimize it. WIP is nothing but the fund is blocked. Now, let us look at the finished goods, same logic. In the case of the same matching principle, had it converted into sales, it would have been good. If it is absolutely required, then it is acceptable. Otherwise, it is not. So what you have learned now, you have not only learned how the P&L and balance sheet is developed from daily transactions, but also meaning of P&L and balance sheet items, whether it is good or bad, why it is happening. Now you see, you started with absolutely no knowledge in accounts, but by this time, I am pretty sure all of you have got complete idea how accounting entries are created from financial transactions and how those accounting entries are getting converted into P&L and balance sheet. Now, what do you understand by increase in WIP in P&L item? This is due to the matching principle. That is, the business entity has incurred certain expenses and it could not sell it. So you have to reduce the expenses. Now, does it increase profit? Yes, it is. Now, is it the manipulation is possible? Yes, it is possible. Because if you increase the inventory, if you jack up the value of the inventory, then manipulation is possible. There's an example. Pompano Beach-based Point Blank Solutions, formerly DHB Industries. The SEC says that the company started overvaluing inventory in 2003. 2 years later, the books were carrying inventory that was overvalued by 33 million. So that means if inventory was overvalued by 33 million, what has happened? So that means they have reduced the expenses by 33 million. So instead of incurring losses, they have shown profit. So yes, overvaluation of inventory can happen. So there is a manipulation is there. Now, who has to check that this is not happening? Auditor has to check it is not happening. Thank you so much. In this session, what we have discussed about the meaning of the different items on P&L and balance sheet. Hope you have been able to get the idea of the meaning of each item and how those items are built up from financial transactions. Thank you so much for watching this video.